Welcome back, traders. Get ready for another action-packed week. Geopolitical and trade risks are back on the rise, with gold trading firm again as everyone waits for Trump's highly anticipated speech before Congress tonight. Meanwhile, euro-dollar keeps fighting for a close above the 1.05 level ahead of a crucial ECB policy meeting this Thursday, while Friday's non-farm report could generate fresh volatility as the US dollar is struggling for a rebound against the Japanese yen. The pair came under renewed downside pressure after disappointing ISM manufacturing data. So this week might be quite volatile. So let's see what the technical signals suggest about these markets. And starting first with gold, we can see that the precious metal is rising for the second consecutive day. There was a clash between the US and Ukrainian presidents last Friday. The US has posed military aid to Ukraine after President Zelensky said that a peace deal is still very far away. So that makes investors wonder whether there will be a peace deal soon. Although both the US and Ukrainian presidents remain optimistic, maintain an optimistic outlook about the relationship between the US and Ukraine. But we also had some negative trade headlines as import tariffs against Canada, Mexico, and China went live today. So that increased demand for safe havens further, and we can see that gold is currently trying to close back above the 2,900 level. And if it manages to do that today, I believe that there's potential for a new record high, probably somewhere near 2,970, where this resistance trend line over here is located. Then above that, the rally could extend towards the 3,010 and perhaps also reaches the 3,030 trend line territory over here before heading higher to meet the 3,100 level, where the upper band of this bullish channel is located. While higher than that, there is another longer-term resistance trend line coming from July 2024 that is seen somewhere between 3130 and 3150. Now, if we look at the technical indicators, we can see that there is that the risk is skewed to the upside given the rebound in the RSI. The stochastic oscillator has also turned up from oversold territory. So that makes me think that this rebound could extend, especially if we close above the 2,900 level. If not, however, then I believe that there might be another test near the 2,855 level, where the price found support yesterday and also last Friday. Then below that, the focus could turn to the 2,790 and 2,812 region, where the 38.2% Fibonacci retracement of this uplift is located. If that fails to hold, then perhaps there might be more losses, with the focus turning towards the 61.8% Fibonacci of 2,720. This has been a key sailing to upside movements back in November and December, so that could be a critical territory to watch. Now, there's another question as regards the technical signals. It seems that the price has completed the wave 1 in the Elliott 1 to 5 bullish pattern. So the big question now is whether the price has also completed the second downside correction and it has started a new bullish cycle. But probably a break above the 2,900 level could provide us with more optimism that a new bullish cycle is probably underway. Now, looking at euro-dollar is also in the green. It has a nice rebound following weaker than expected US PMI figures on Monday. The price is again trying to close above the 1.05 level, and the 1.0530 territory has been also a key resistance. So a close above that could probably confirm additional gains, particularly if the 38.2% Fibonacci retracement of this downfall at 1.0572 gives away. Don't forget that we have the ECB rate decision this week. Investors expect are almost certain that the central bank will deliver another 25 basis point rate cut. That would be the 6th in a row. But given the stickness in inflation data and we recently had a stronger than expected inflation report which came out yesterday, so that further helped the euro dollar to continue higher. And given all these stronger than expected Eurozone data, I'm a bit suspicious about whether the central bank will deliver a 25 basis point rate cut this week. Perhaps some hawkish rhetoric might be likely among policymakers, but definitely if the central bank decides to surprise with steady interest rates this week, that could help euro dollar to gain significant positive momentum. So in this case, if we successfully close above the 1.0572 level, then I expect a rally towards the 1.07 and 1.0725 region, where the 50% Fibonacci retracement level of this downfall, as well as the 200-day moving average, are both placed. Then higher than that, the 61.8% Fibonacci of 1.0817 could be the next target. Now, in case the central bank decides to use a dovish tone, if it signals more rate cuts as investors anticipate another 25 basis point rate cut in April, if it confirms that case, then euro dollar could reverse to the downside to retest the 1.0388 and 1.0420 level, where the 20 and 50-day moving averages are placed. There is a tentative support trend line within the same region, so failure to pivot here could direct the price towards the 1.03 level, and then lower than that, I expect some consolidation to emerge around the support trend line coming from the 2022 low at 1.0215. If there are more losses from here, then I expect a sharp decline towards the 1.0093 level, where the February 2024 support line is placed, and then lower than that, the case of parity could come back under examination. While looking at the technical indicators, it seems that the risk is still skewed to the upside. We can see that the RSI is still has returned above its 50 neutral mark. The stochastics have also pivoted higher, so there's scope for more gains. However, for that to happen, to confirm a new bullish cycle, I would like to see close above the 1.0530 number. And finally, looking at dollar yen and the US non-farm payrolls report, which is due this Friday. While the data are expected to show some improvement in employment growth, analysts see an increase of 160,000, up from 143,000 back in January. The unemployment rate could stay steady. Average hourly earnings could also stay steady around 4.1%. So the report overall, if it comes as expected, it could be still a solid report. Particularly if it shows that federal layoffs have been offset by increases in other job increases in the private sector. So if that happens, perhaps that would be positive for the US dollar, which is currently facing another negative day following its pullback near the 20-day exponential moving average near 150. We can see that the 149 level failed to support the market today, so the next support territory is seen around the 147.80 number, where the lower band of this bearish channel is placed. If that fails to protect the market, then the decline could extend towards the 61.8% Fibonacci retracement of this up leg seen near 147, and then below that there might be a pause near the 145.90 territory before we continue towards the 145 psychological mark. Now, if we're looking at the technical indicators, they're all pointing downwards. Their size has reversed to the downside. The stochastics have also turned down, so that reflects weakening market sentiment. However, if the price manages to rebound, if it manages to return above the 149 level, then perhaps we may see another test somewhere between 151 and 151.50, where the 38.2% Fibonacci retracement of this applet is placed. The 200-day exponential moving average and the 50-day EMA are also nearby, seen between 152 152.50. So a successful penetration higher from here could provide a strong boost to the price, likely taking us up to the 23.6% Fibonacci of 154.30. The ISM non-manufacturing PMI data are also coming out this Wednesday, so those will be also closely watched given the disappointing consumer sentiment data that was released last week. So there are growth jitters are back in the US, and the Fed is currently expected to deliver 3 rate cuts based on futures markets. That's a more dovish pricing than the Fed's pricing itself. So if the data question the number of rate cuts priced in markets, then that could provide some relief to the US dollar. On the other hand, more disappointing numbers could probably create more selling in this market. So that's everything I wanted to share with you guys. Thank you for watching, and see you next time. Bye bye for now.